Welcome. We're so glad you've come to watch today. We're about to take a stack of dense, really complex financial filings and do what we do best.
Distill them. We're going to find the most critical insights, the strategic moves, and all those surprising little nuggets of knowledge.
Exactly. We do all the heavy lifting so you can walk away truly well-informed.
And if you do find this valuable, and we think you will, please just take a second to hit that like button.
Yeah, share this video with someone who needs this analysis, and definitely subscribe. It ensures you stay tuned for all of our deep dives.
Your support really does keep us going, so, please also consider checking out our channel membership options.
Or you can always use super thanks to show your support. And for that, we thank you.
Okay, so let's get into it.
Today, we are undertaking a deep exploration of a giant. A company that touches almost every corner of the travel world. Marriott International, Inc., ticker MAR.
And our focus is surgically precise. We're looking at their most recent quarterly financial report, the Form 10Q.
Right, for the period that ended September 30, 2025.
That's the mission. We're translating all that dense technical language from the SEC filing into clear, actionable intelligence.
So for you, the learner or the investor, this is your shortcut.
We aren't just reading metrics off a page. We are decoding management strategy, finding where they are putting their billions, and identifying the structural shifts that are shaping global hospitality right now.
And the central tension we found right from the start, the core narrative for you to keep in mind is this.
Go on.
Marriott is running this finely tuned asset-light machine that is delivering soaring profitability.
But, and this is the big but, that soaring profitability is masking some significant operational deceleration.
And it's happening in their largest and most important market, the U.S. and Canada.
Exactly. We're going to use this Q3 report to really confirm that narrative. It's a story of, extraordinary financial engineering and global ambition.
Even as those post-pandemic recovery tailwinds, they're starting to sputter a little bit in their own backyard.
Yep. So we'll verify the financial health, dissect the performance of their core operational engine, and examine a really massive strategic brand acquisition.
And we'll look closely at the persistent legal risks they are still carrying.
Let's do it.
Okay, let's begin at the source, the Form 10Q itself. For those tuning in who might not be regular readers of these filings, maybe just a quick primer. What is the 10Q?
Well, think of the 10Q as the corporate equivalent of a quarterly doctor's visit.
Okay, a checkup.
Exactly. It's a mandatory checkup filed every 3 months with the Securities and Exchange Commission, the SEC. It gives investors and the public a detailed, standardized view of the company's financial performance.
And their balance sheet health, risk factors, all of that.
All of that. Now, it's different from the annual 10K because it's unaudited, but it's absolutely essential for timely insight into how the business is doing.
And for Marriott specifically, what makes their 10Q stand out, especially when you compare them to, say, traditional hotel owners?
What's really unique about Marriott's 10Q is that the most critical information, it isn't in the sections about owning property or massive capital expenditures.
Right, because they don't own most of the hotels.
Exactly. Instead, we have to dive straight into the notes on fees and intangibles. The core of their business is not real estate. It's brand licensing, it's management contracts, and it's the monetization of that massive loyalty program.
So when we look at their structure, which is confirmed again in this filing, they're still a large accelerated filer.
Which just signifies their massive scale and financial maturity. It's table stakes for a company this size.
So let's drill straight into the overall Q3 summary. What was the headline story? What's the state of their financial health for those 3 months?
The headline is efficiency over sheer scale. The quarter showed, pretty moderate revenue growth, which is fine.
Okay.
But it displayed a disproportionate and, frankly, aggressive jump in net income and operating leverage.
So more profit from each dollar of revenue.
Way more. This is the clearest evidence that their asset-light management and franchise model, Marriott's core identity, is generating profits at an accelerating rate. The machine is just running cleaner than ever.
Okay, let's unpack this with the core numbers. I'll read out the comparison for Q3 2025 versus the same period in 2024, and you give us the strategic context. Why do these changes matter so much?
Let's do it. Let's dissect the score sheet.
All right. First up, revenue. $6,489 million in Q3 2025. That's up 3.7% from $6,255 million in Q3 2024.
So that's a decent number. 3.7% growth. It signals a maturing market. We've moved past those explosive 20 to 30% growth rates we saw right after the lockdowns ended.
We're back to normal, basically.
We're back to a stable mid-single-digit expansion. And for a company of this magnitude, that's a healthy baseline. But that growth rate, it really only tells half the story.
Okay, because next we have net income, $728 million in Q3 2025. And that is up a remarkable 24.7% from $584 million.
And this is where the magic happens. A company of Marriott's size increasing its net income by nearly 25% on a revenue base that only grew by 3.7%.
It means they've unlocked some serious operating leverage.
Powerful operating leverage. They have largely fixed or steady central costs, for technology, marketing, the Bonvoy loyalty program infrastructure, and every single incremental dollar of high-margin fee revenue drops straight to the bottom line.
Wow.
This confirms that their platform monetizes better than almost anyone else's in the business.
Which brings us to diluted earnings per share, EPS, $2.67. This is up 29% from $2.07 in Q3 2024.
And notice the difference there. Net income grew 24.7%, but ETS grew 29%.
So it grew even faster.
It grew faster. That difference at 4.3 percentage points, that's the explicit impact of their capital allocation strategy.
The share buybacks.
Exactly. By aggressively repurchasing their own shares, they reduce the total number of shares out there, which makes the earnings available for each remaining share artificially higher. It's financial engineering working precisely as intended. We'll get into that more later.
Okay, and finally, a quick look at the efficiency ratios for Q3 2025. Operating margin, about 18.2%, and net income margin, about 11.2%.
Those are spectacular margin figures for what is, at its heart, a service industry. When you compare them to integrated hotel owners, Marriott's margins are just dramatically higher.
An 18% operating margin. That shows incredible cost discipline.
It does, and it shows that the structural avoidance of holding expensive real estate pays dividends, both figuratively and literally. These are significant improvements that just underscore the company's shift toward maximizing fee extraction.
The outlook section was also pretty important here. Management expects full year 2025 net rooms growth to approach 5%, and that includes the rooms from the newly acquired citizenM brand.
And that's a huge deal. That 5% rooms growth is the oxygen for the entire fee-generating structure. It sets the foundation for all future fee revenue.
So to really understand that massive jump in profitability, we need to dive into where that money's coming from, the revenue composition.
Yes. Where specifically is that high-margin cash coming from?
Well, we see net fee revenues, the heart of the asset-light model. They increased by $52 million, or 4%, hitting $109 million.
Right, but the components within that $1.3 billion are shifting. And they're shifting dramatically toward pure intellectual property licensing and monetization.
How so?
Well, franchise fees, which is basically Marriott just lending its brand name to hotel owners, showed the largest growth. They were up 8% to $876 million.
And that's a tandem effort, right? Driven by more rooms and something else?
Exactly. It's driven by the expansion of the global room count and, maybe more critically, by the sheer power of the Bonvoy loyalty ecosystem.
Let's focus on that loyalty aspect. The filing specifically breaks out co-branded credit card and other brand-related fees. How much did that non-room-based income stream contribute?
It was a powerhouse quarter for what you could call passive monetization. We saw a $34 million increase in co-branded credit card and other brand-related fees just in Q3.
$34 million from credit card.
Yes. This confirms a crucial strategic pivot. Marriott isn't just an accommodation provider anymore. It's a financial products platform.
So every time someone swipes their Bonvoy card,
at a grocery store or a gas station, anywhere, Marriott earns a highly profitable royalty or licensing fee. And this revenue stream requires zero operational cost on Marriott's side. It's a massive, stable, high-margin anchor for the whole business.
Okay, but here's the wrinkle. I found this really interesting. It challenges that simple narrative of everything is great. Incentive management fees, or IMFs, they actually decreased by 7% to $148 million in Q3. Given the 25% surge in net income, why would the performance bonuses paid by hotel owners to Marriott go down? That seems completely counterintuitive.
It is counterintuitive, but it's a critical analytical point, and it forces us to look past those big consolidated numbers.
Yep.
IMFs are the bonus fees Marriott earns only after the individual property owner achieves a pre-established contractual return on investment threshold. Think of it as profit sharing.
But only after the owner makes their money back first.
Precisely. after they recoup their equity cost and debt service. So if the IMF is down, that implies one of two things, or probably both.
One being?
One, RevPAR growth is moderating or even declining in key markets, which we're about to see, making it harder for properties to hit those revenue targets.
And two?
Two, inflationary pressures, specifically high costs for labor, energy, maintenance, are eating into the owner's operating profits. So this cost absorption means fewer properties are crossing that high IMF threshold.
Even if Marriott, the franchisor, is still getting paid its guaranteed base fees.
Exactly. That structural reality is a huge distinction. The overall profitability surge, that 25% net income growth, is therefore being driven almost entirely by the central high-margin fee mechanism.
The franchise licensing, the base fees, and that credit card revenue, they're acting as a buffer against what's really happening at the property level.
Precisely. The profitability is leveraged and centralized. It shields the corporate entity from the local market volatility and cost pressures that its partners are facing.
Which brings us to that platform, the loyalty program, Bonvoy.
Yeah.
It's a financial leviathan. The liability number is almost unimaginable for a non-financial company.
It's perhaps the single most important non-physical asset Marriott holds. The liability for the guest loyalty program stood at a staggering $7,820 million at the end of Q3.
$7.8 billion. And that number grew by over $300 million this year alone.
It did.
So for the listener, why is this massive liability figure actually a measure of corporate strength? It sounds like a bad thing.
Because it represents an interest-free float. It's money that Marriott has collected upfront from its credit card partners and from points purchases, while they have a future obligation to provide a room or a service.
Which is the liability.
Right. But the cash is in hand, earning interest for them right now. It's effectively a prepaid sales channel. And the scale of it ensures this unparalleled customer stickiness. It makes it harder for members to leave because of the perceived value of all the points they've saved up.
And they are turning that liability into actual revenue.
Oh, absolutely. The filing shows they recognized $2,589 million in deferred revenue from that program as actual revenue in the first 9 months of 2025.
Nearly $2.6 billion of cash converted to income just by members redeeming points.
Exactly. The scale and the consistent monetization of Bonvoy they're unparalleled in the industry.
Okay, so the financial scorecard is clear. Exceptional leverage profitability fueled by high margin fees. But now we need to see what's happening on the ground.
Time to look at the operational reality.
Now we shift from financial engineering to operational reality by analyzing RevPAR revenue per available room. This metric tells us if the rooms are full and if prices are holding up.
And the global numbers show a clear shift. It's all about moderation now. Worldwide, system-wide RevPAR increased only by 0.5% in Q3, just 0.5%.
Wow, that's pretty flat.
It is. It landed at $131.43. And when you peel back that tiny increase, we see the entire gain was driven by average daily rate, or ADR. That was up 0.9%.
So they're just charging more.
They're charging more because occupancy actually dipped slightly by 0.3 percentage points.
That's a powerful signal.
Yeah.
It means the industry is relying completely on pricing power and just trying to fight off occupancy slipping.
It is. And this is where the tension we mentioned at the top becomes really acute. What's happening in the crucial U.S. and Canada domestic market?
And this is the big one.
This is the most challenging takeaway from the operational data. The U.S. and Canada market, the system's largest cash cow, it actually experienced a RevPA decrease of 0.4% in Q3.
A decrease. So it's contracting in their home territory. That's a profound change from the recovery years.
It is. A contraction means that whatever growth they're seeing internationally is directly being used just to offset this domestic headwind.
So what were the specific reasons management cited for this unexpected softness?
The language in the filing, it pointed directly to a deceleration in business travel. They noted 3 specific pain points.
Okay.
First, weaker business transient demand. So your classic road warrior, the corporate traveler, isn't driving the volume they need.
Right.
Second, softness in government travel. Spending in that segment is clearly tightening up. And third, weaker group demand. So large conventions, major corporate events, they're not booking at the pace they once were.
And they said this was hitting a particular type of hotel, right?
Yes, and this is key. They noted these issues were particularly hitting select service hotels.
So not the big fancy resorts.
No. The full-service luxury properties like a Ritz-Carlton or St. Regis, they can still command that pricing power, and they appeal to resilient, high-net-worth leisure travelers. But the select service market, think Courtyard or Residence Inn, they are the true barometer of the middle-tier business traveler.
And that traveler is simply not back at full strength.
Not at all. Likely due to permanent shifts toward remote work or just more video conferencing.
So if Q3 showed a decrease, how's the domestic market holding up for the year so far?
The year-to-date RevPAR growth for the U.S. and Canada is still profoundly low. It's just 0.9%.
Less than 1%.
Yep. This confirms the challenge isn't a one-quarter fluke. It's a sustained, challenging domestic environment where leisure demand has peaked, and that traditional high-volume business demand just hasn't rebounded enough to compensate.
Which is why the strategy is so focused on international expansion.
Exactly. The domestic pond is getting shallower.
Which brings us to the operational counterpoint. International resilience. This segment has to be the system's growth anchor.
And it is the strategic shield. International regions collectively grew RevPAR by 2.6% in Q3 and 4.6% year-to-date. This diversity proves that Marriott's geographic spread is delivering real, tangible operational stability. It's offsetting the weakness at home.
So let's break down those international success stories. Where is that growth actually coming from?
We have two major stars. First, APEC, which is Asia-Pacific excluding China. That region delivered the highest RevPAR growth in Q3 at 4.7%.
And an impressive 8.1% year-to-date.
Yeah, that region is capitalizing on sustained domestic and intra-Asia travel demand, especially in the luxury segment.
And the second star, which can be volatile but is high-performing right now, is the Middle East and Africa.
Exceptional performance there. That segment reported massive Q3 RevPAR growth of 8.7%.
Wow.
And what's most impressive is the composition of that growth. It was driven by both occupancy, which was up almost 2 percentage points, and ADR, up 5.5%.
So that's real demand, not just price hikes.
That's genuine, powerful demand absorption. It's likely spurred by major global events, strong inbound tourism, and just sustained regional economic activity. It's giving Marriott excellent pricing authority there.
Okay, now for the biggest macro watch point, Greater China. This market is so central to Marriott's long-term future, yet its current performance is troubling.
Greater China is the definitive anchor dragging down the overall international picture. RevPAR there was absolutely flat, 0.0% change in Q3.
Flat, and for the year.
Year to date, it was actually negative, down 0.6%.
And management pinned this directly on soft macroeconomic conditions.
Yeah.
So for the listener, how does this link back to the wider Chinese economy?
When a company uses that phrase, soft macroeconomic conditions, in an SEC filing, it's a direct pointer toward low consumer and corporate confidence.
Right.
In China, this manifests as reduced domestic travel spending, corporate budget tightening, and caution in group bookings. So the problem isn't necessarily a failure of Marriott's brand execution.
It's a failure of the overall economic engine to generate the spending needed for travel.
Precisely. And this is critical because it introduces a high degree of dependence on external factors. Marriott has made massive long-term bets on this market, which we'll see in the pipeline data. But today, those bets are stalled by a weak domestic economy.
So the growth engines in APEC and the Middle East are basically working double time.
They are, just to make up for the lack of growth coming out of Greater China.
And we should briefly touch on Europe. Moderate RevPAR growth of 0.8%, but a really impressive ADR.
Yeah, that comparable company-operated ADR was $382.64. That is a statement about the resilience of European luxury travel.
$382 a night on average.
For their full-service, managed properties. While the wider regional system only saw modest growth, the high-end traveler is clearly willing to pay top dollar for the Marriott luxury experience in major European cities. It confirms they have strong price integrity where it matters most.
Okay, let's pivot from looking at Q3 performance to looking forward at future strategy. And the clearest signal of Marriott's direction is the huge strategic investment they made this quarter.
The acquisition of the citizenM brand. This was a massive statement purchase.
They completed the asset acquisition of the brand and its IP in Q3 for $355 million.
This isn't just about buying a competitor. It's about buying into a future segment.
So what exactly is citizenM, and why is it worth over $1/3 billion to Marriott?
citizenM is an innovator. They're in that affordable luxury or modern select service lifestyle segment. Their hotels are high design, very tech integrated.
Usually in big city centers.
Exactly. They cater specifically to a younger, design-conscious business and leisure traveler who values efficiency and style over, traditional, extensive, full-service amenities.
So for Marriott, it addresses a gap in their portfolio.
It does. While they have massive traditional brands, they need a stronger, recognized global player in this modern lifestyle space that doesn't require them to own massive real estate.
And citizenM gives them 37 existing hotels.
8,789 rooms, and a global platform that Marriott can now rapidly scale using its existing franchise infrastructure.
Let's talk about the accounting of that $355 million price tag, because it tells us what they truly valued in the deal.
It absolutely does. The cost was overwhelmingly allocated to intangible assets, not physical property. $289 million went to an indefinite-lived brand asset.
Okay, indefinite-lived brand asset. What does that mean in practical terms?
It means Marriott believes the citizenM name and the concept will generate cash flow indefinitely. They're saying the value isn't in the bricks and mortar, which, again, they don't own. It's in the intellectual property, the brand standards, and the goodwill that comes with the name.
So it's a perfect fit for their asset-light model.
A perfect fit. This valuation confirms they bought citizenM because they believe this brand will be scalable for decades to come without requiring expensive, depreciable physical assets.
The deal also includes a pretty significant incentive for the original owners to help them grow it, right? Through an earnout structure.
Yes, up to $110 million in potential earnout payments. And it's contingent on future brand growth over a specified multi-year period.
So it's not a clean break. It's a commitment to shared success.
Exactly. Marriott is betting on its ability to leverage its global development pipeline and the Bonvoy system to massively accelerate citizenM's presence worldwide. And they've incentivized the original leadership to help them achieve that ambitious goal.
So let's put this acquisition into the context of Marriott's existing scale and its forward-looking pipeline. At the end of Q3, what does the total system look like?
The scale is just colossal.
Mm-hmm.
9,721 properties, 1.75 million rooms globally.
And year-to-date, they've added roughly 47,400 net rooms.
Which is a massive organic expansion even before you start integrating the citizenM rooms, which will happen in Q4.
But the sheer size of the development pipeline, that's the number that should grab everyone's attention.
It's staggering. We're talking about approximately 3,900 properties. That translates to over 596,000 rooms that are already approved or planned for future opening.
That's enough to nearly create another major global hotel chain just in their queue.
It really is.
And if we connect this back to our operational insights, the domestic slowdown and the international growth, how does the geographic breakdown of that nearly 600,000 room pipeline look?
It is the ultimate confirmation of the strategy. The filing highlights that over half of that total pipeline is located outside the U.S. and Canada.
So the blueprint is clear. Stabilize the U.S. cash flow.
And pour capital and development resources into faster-growing international markets. And the pace is aggressive, too. Over 250,000 of those rooms, or 42% of the total pipeline, are already under construction or converting. This growth isn't theoretical, it's physically underway.
And drilling into the regional rooms growth, we can see where the true commitment lies, even with the current headwinds.
Yes. Both EMEA, Europe, Middle East, and Africa and Greater China saw significant property growth. A 16% increase in properties year over year in each of those regions.
That 16% jump in China's property count, even when RevPAR is flat, that is the ultimate long-term bet.
It is. Even if performance is weak today because of the macro economy, Marriott is planting flags for the next decade. They're anticipating a powerful rebound in Chinese travel demand when those economic conditions finally stabilize.
We've established that Marriott is a leveraged fee-generating machine with a huge global development focus. Now we have to look at how they are funding all of this.
Right, which brings us to the balance sheet and their very aggressive capital allocation decisions.
And the theme for Q3 capital management seems to be leverage and shareholder reward.
Absolutely. The year-to-date net cash used in financing activities was $1,339 million. And that was primarily driven by two things: debt issuance and stock repurchases.
The amount of new debt is remarkable, especially given the global interest rate environment. How much did they take on?
They were very active in the debt markets. Year-to-date, they issued a substantial $3.436 billion in new long-term debt.
Over $3.4 billion.
Across 5 new series of senior notes. Now, this was partially offset by about $957 million in repayments, but the net intake was still massive.
Taking on that much new debt when borrowing costs are rising is a bold move. What does that signal?
It signals management's supreme confidence in future EBITDA generation. They are essentially betting that the internal rate of return on their investments, which are mainly stock repurchases and strategic acquisitions, outweighs the cost of that debt.
Even at today's higher rates.
Even at higher rates. They're leveraging the stability of their high margin fee revenue to execute a financial engineering strategy focused on maximizing EPS growth.
And what was the stated purpose for these debt proceeds?
The proceeds were explicitly earmarked for general corporate purposes. That includes capital expenditures, acquisitions, which of course covers the citizenM purchase,
And the most critical allocation.
stock repurchases. This confirms the new debt is primarily financing the return of capital to shareholders, not some massive operational expansion.
So what does their resulting debt profile look like? Are they managing the risk? Okay.
Well, the total long-term debt is nearly $16 billion. They're managing the risk by staggering the maturity dates. The weighted average maturity is about 5.6 years, and the weighted average interest rate is 4.6%.
4.6% is pretty good in this environment.
It suggests they secured favorable terms, likely before the full impact of rate hikes was really felt in the market.
And their liquidity depends on a big $4.5 billion credit facility. How close are they to tripping any of those critical debt covenants?
The key covenant here is the maximum leverage ratio adjusted total debt to EBITDA. It cannot exceed 4.5 to 1.0.
And are they okay?
The filing explicitly confirms they are currently satisfying this covenant. This is a critical point of reassurance for investors. They're being aggressive, but they are operating within the boundaries set by their lenders.
Okay, let's discuss the other side of that equation. Shareholder returns. The magnitude of their stock buybacks is central to this whole Q3 financial narrative.
It is the dominant use of their cash flow, supplemented by that new debt. Year-to-date, through October 30, Marriott repurchased 9.7 million shares,
Totaling how much?
totaling $2.6 billion. And they accelerated the spending in Q3 alone, buying back $800 million worth of shares just in that quarter.
So we connect this right back to our opening financial discussion. That 29% EPS growth that outpaced the 25% net income growth is directly attributable to this calculated massive share repurchase program.
Absolutely. It's a clear signal from management. They believe their own stock is the best possible investment available right now. By reducing the float, they permanently boost per-share metrics, which tends to support the stock price and reward long-term holders.
And they doubled down with the dividend.
They did. They increased the quarterly cash dividend to 57 cents per share, up from 63 cents. It just confirms the expectation that they're going to continue these robust cash returns.
Finally, we have to talk about the persistent shadow on their balance sheet. The Starwood data security incident. It's years old now, but still carries legal weight.
This is a complex, long-running legal battle. It's related to the unauthorized access of the Starwood reservations database, which was discovered way back in 2018.
But they actually secured a significant legal victory in Q3 this year.
They did. The U.S. Court of Appeals reversed the lower court's certification of the multi-district litigation, or MDL, class of consumer plaintiffs.
What's the legal nuance there? Why is reversing class certification so important for Marriott's financial exposure?
It dramatically limits the total potential payout. The court determined that a class action waiver in the user agreements was enforceable.
So what does that mean in simple terms?
It essentially prevents millions of affected consumers from consolidating their claims into one gigantic high-stakes lawsuit. Instead, Marriott will likely only face numerous smaller, individual claims, which are significantly easier and cheaper to manage and settle. It limits that catastrophic risk.
And the company also recorded some positive financial news related to this in Q3.
That's right. They finalized some insurance recoveries related to the incident, which gave them a positive impact of $40 million on their income statement, a welcome offset to all the ongoing legal expenses.
However, despite the legal wins and the insurance money, the core financial risk has not been fully quantified.
And this is the critical, non-quantifiable tail risk we have to highlight. Marriott explicitly disclosed that the company is still unable to reasonably estimate the amount or range of possible financial impact in excess of the expenses already recorded.
So even with the class action threat gone?
The ultimate financial cost of this breach remains uncertain, hanging over the company for the long term.
We've translated this massive, detailed document, identifying the strategic tension, the global pivot, and the financial engineering at work. Now, let's synthesize all of this into the 5 most salient, lasting points for you.
Let's summarize the blueprint that emerges from this Q3 2025 10Q.
Okay, takeaway number 1. A huge profitability surge driven by fee leverage.
Right. The core story is efficiency. Net income and operating income grew by roughly 25% in Q3, just crushing the 4% top-line revenue growth. This confirms the strength of Marriott's asset-light model.
Which leverages those high-margin revenue streams like base fees and the credit card program.
Exactly. To drive centralized profitability, effectively buffering against any local operational softness.
All right. Takeaway number 2. The U.S. market is now a deceleration anchor.
The operational headwinds are very real. U.S. and Canada RevPAR decreased 0.4% in Q3.
And that's driven by sustained softness in business, government, and group travel.
Yes, and it's particularly impacting those critical select service segments. Domestically, Marriott now has to rely more heavily on resilient luxury segments and cost management rather than on volume growth.
Okay. Takeaway number 3. The strategic acquisition of a modern, scalable platform.
The big ticket, $355 million acquisition of the citizenM brand, with the bulk of the cost allocated to that indefinite-lived brand asset, demonstrates a clear strategic commitment.
They're buying their way into the modern, high-design, select service lifestyle segment.
And leveraging their balance sheet to do it, to rapidly secure future platform diversity that aligns with younger, more design-conscious travelers.
Next takeaway number 4. An aggressive, debt-fueled shareholder return strategy.
Management spent $2.6 billion on share repurchases year to date.
And they partially financed that by taking on over $3.4 billion in new debt.
It's a clear signal of management's high confidence in future cash flow. And it shows their commitment to using financial leverage to actively boost diluted EPS, rewarding shareholders even as domestic operations moderate.
And finally, takeaway number 5. Future expansion is overwhelmingly global.
The operational strength in international RevPAR, which was up 2.6% in Q3.
Coupled with the fact that over half of that colossal 596,000-room development pipeline is situated outside the U.S. and Canada.
It just confirms that the structural growth of Marriott's footprint is focused on global markets. They're targeting sustained recovery in APEC and EMEA and making massive long-term bets on China.
So this filing, it really leaves us with a clear view of an industry leader adapting.
They're using their financial strength and their global reach to make big bets on the future while trying to mitigate the localized slowdowns that define the current environment.
As we conclude this deep dive, here is a final provocative thought for you to consider.
Marriott is leveraging its balance sheet and doubling down on a massive development pipeline, especially in regions like Greater China, where current RevPAR is flat or even negative due to those soft macroeconomic conditions. If that debt-fueled capital is locked into development that won't bear fruit until the Chinese economy fully stabilizes and corporate travel returns, what does that timing exposure do to Marriott's short-term ability to maintain its aggressive share repurchase program if the U.S. market weakness persists longer than expected?
That is the delicate balancing act management is performing right now.
It is.
Absolutely fascinating analysis today. This 10Q isn't just a report, it's a strategic map of a market leader in transition. Thank you so much for engaging with us and letting us be your guides.
We hope this exploration was informative and gave you those critical aha moments.
Please click that like button, share the video with someone who needs this knowledge, and subscribe so you don't miss our upcoming content.
And remember, if you want to support us in making these detailed analyses possible, please evaluate becoming a channel member.
Or you can use Super Thanks to show your support. It helps us tremendously in creating ongoing videos.
Until the next deep dive, stay curious.
And stay well informed. Farewell.